Welcome to The Explainer. You ever see a company's value just explode by billions overnight, and you're left wondering, wait, what did they invent? Well, a lot of the time, the answer isn't a new product, it's a new story. Today, we're opening up the secret playbook of top board advisors to show you the financial engineering moves that create that magic.
So, let's kick things off with a puzzle that, honestly, seems impossible. How do you turn $1.7 billion in profit into $42 billion of value? I mean, the math just doesn't add up, right? But this isn't a trick question. This is the exact kind of thinking that goes on in the biggest boardrooms in the world. It's what separates the good companies from the truly legendary ones.
And you're not going to find the answer in a standard accounting textbook, that's for sure. To crack this, we have to think way beyond simple addition and subtraction. Because boards, they're not impressed by simple sums. They're impressed by smart strategy, by leverage, and this is the key, a powerful story that's told through the numbers.
All right, let's get into it. Play number one from the advisor's playbook is what we call the value play. And this one is fascinating because it's not actually about earning more money. It's about changing how the market values the money you're already making. So the key concept we need to wrap our heads around is the PE multiple. That's price to earnings. The easiest way to think about it is like a quality score for your profits. The market, you see, is willing to pay a way higher price for every dollar of earnings that it thinks is safe and predictable. And on the flip side, it'll pay a lot less for earnings that feel risky or like a one-time thing.
Because, and this is crucial, not all revenue is created equal. Not even close. So on one side, you've got your transactional revenue, right? A one-time purchase. It's good, but investors kind of shrug. They see it as less predictable. But then on the other side, you've got recurring revenue. Think subscriptions. Oh man, the market loves this stuff. They love the predictability, and they will pay a massive premium for it.
And this right here, this is where you see the sheer power of that shift in action. Just by converting a pretty small slice of a company like Walmart's revenue into a recurring membership model, you change the whole perception of that income. And that change is so drastic that it unlocks, get this, a staggering $42.5 billion in market value. It's incredible.
So, imagine you're the advisor walking into that boardroom. The message is crystal clear. Folks, this isn't just about an extra $1.7 billion in profit. This is about fundamentally re-engineering the company's valuation. We're making our earnings safer, and in doing so, we're making them way more valuable to investors. Okay, let's move on. Play number two is the margin play. And this one is really clever. It's a strategy where you use a business that doesn't make much profit to secretly fuel another business that is a massive, high-profit machine. So the strategy is all about perspective. You have to see your main business, let's call it the anchor, not just for its own sales. You have to see it as a machine that gets a much more profitable flywheel spinning. The anchor is what draws everyone in, but it's the flywheel that's actually making the real money. And here's a perfect example of what that looks like. You've got Unit A, the retail business. It makes a big $1,000 sale, but you know what? It only keeps $30 in profit. Now look at Unit B, the ad services business. It makes a way smaller sale, just $100, but it keeps $80 of that as pure profit. The difference is huge.
Let me put that another way for you. The ad business is 26 times more efficient at generating profit. It's like the hidden engine of the entire company. And that big retail business, that's just providing the fuel.
So, back in the boardroom, here's the big reveal. The pitch is, our retail business isn't really just selling goods, it's acquiring data inventory. And that data is what we need to run our hyper-profitable ad business. See, every single customer interaction becomes a chance to learn, to target, and to make a ton of money through that high-margin flywheel.
All right, on to play number three, the leverage play. Now, this is how you walk into a room and justify spending an absolutely enormous amount of money on stuff like automation. And you do it by proving that your profits are going to grow much faster than your sales.
This brings us to a concept called degree of operating leverage, or DOL for short. Don't let the name scare you. It's actually pretty simple. It just tells you how much extra profit you can squeeze out for every single extra dollar you make in sales. So a high DOL means you've built an incredibly efficient profit machine. Think about it like this. With manual labor, your costs pretty much grow right alongside your sales. More sales, more wages. But with an automated setup, yeah, you have high costs up front to build it, but after that, the cost of each additional sale is almost nothing. And that is how a 10% bump in sales doesn't just mean 10% more profit. No way. It can lead to a 30% profit explosion. In this concept, this leverage is exactly why a company would spend a mind-boggling $24 billion on capital expenditures. They're not just trying to be a little more efficient today. They're building this powerful leverage effect for the long haul. So the takeaway for the board is incredibly powerful. The advisor says, look, this massive $24 billion spend, it's not an expense, it's a strategic investment. We are building a machine where our profits will accelerate at triple the rate of our revenue. I mean, come on, that is a total game changer.
Okay, for our final move, we're shifting gears a little. This is the defensive play. And this one isn't about chasing growth, it's about something just as important, protecting the incredible value you've already built. And the way you do that is by turning those vague, scary fears into cold, hard numbers.
The tool for this is called risk exposure. It's actually a pretty simple formula. You take a big worry, something like inflation or supply chain chaos, and you calculate its potential impact in actual dollars. And just like that, you transform this vague anxiety into a data point you can actually do something about. So a good advisor would map out the specific things driving a risk. Let's say it's last-mile delivery inflation. Okay, what are the variables? Rising fuel prices, rising labor costs. They plug those in, and then they calculate the precise impact, which in this case looks like a pretty tiny 0.5% hit to the margin. But here's the thing. For a business the size of Walmart, that tiny 0.5% margin hit, that translates to a massive 2.2 times billion-dollar risk exposure. All of a sudden, that vague threat has a very real and very, very large price tag attached to it.
And this is the final absolutely brilliant move. The advisor takes that $2.2 billion number to the board, but not as a problem. They present it as a justification. It creates urgency, and it reframes that huge investment in automation we were just talking about. Suddenly, it's not just a play for growth. It's a defensive shield that completely neutralizes this specific multi-billion-dollar risk. It connects everything together.
So we've gone through 4 really powerful plays. What's the common thread here? What connects all of them? Well, it's all about adopting the advisor's mindset. And here's the main takeaway. True financial engineering isn't really about the complex math. It's a strategic communication tool. It's about shifting the whole conversation from, hey, what did we sell, to how did we create value? It's about using numbers to tell a much more compelling, a much more ambitious, and ultimately a much more valuable story.
So, I'll leave you with this final thought. You have the playbook now, so start looking for these moves out in the wild. Ask yourself, what massive, seemingly low-margin company do you think is quietly using its scale to build a high-margin flywheel right under our noses? Once you see it, you can't unsee it.